I just constructed a $500,000 dividend portfolio from the ground up, and I'm sharing the full allocation, every ETF, every percentage, and the reasoning behind each choice. This isn't hypothetical. This is real capital I'm deploying right now. The objective? Roughly $18,000 in dividend income in year 1, growing to more than $35,000 annually by year 10, without adding another dollar. I'm using 4 carefully chosen ETFs to balance income, growth, and stability. I'll walk through the allocation percentages, the purpose of each fund, and the tax strategy that ties it together. If you're building toward $500,000, this can serve as your framework. Here's what we'll cover. First, I'll show the complete portfolio breakdown with exact dollar amounts and percentages for each ETF. Then, I'll explain why each position is there and how the funds complement one another. Next, I'll outline projected dividend income for year 1, year 5, and year 10, including growth assumptions. Finally, I'll cover account structure, tax efficiency, and the rebalancing method designed to keep this portfolio working long-term. By the end, you'll have a roadmap you can adapt, whether you're investing $50,000, $500,000, or $5 million. Quick disclaimer before we begin. This reflects my personal strategy based on my goals, timeline, and risk tolerance. It's educational content, not financial advice. I'm not a licensed financial advisor. Your situation is different. Tax rules change, markets fluctuate, and historical returns don't guarantee future performance. Always consult qualified financial and tax professionals before making major investment decisions. This is what I'm doing. You must decide what fits your plan. Now here's the full $500,000 allocation. Position 1, $200,000 in SCHD, 40% of the portfolio. This is the core foundation. SCHD emphasizes high-quality dividend growth companies and currently yields around 3.6%, producing approximately $7,200 annually. But the real strength is dividend growth, historically around 12% per year. That means income increases over time without new contributions. The low expense ratio, strong profitability standards, and consistent cash flow make this the anchor holding. Position 2, $150,000 in VTI, 30%. VTI represents the entire U.S. stock market with more than 3,500 companies. The yield is modest at roughly 1.4%, generating about $2,100 annually. But this position isn't focused on income. It's focused on growth and diversification. Historically, the total market averages around 10% annual returns. SCHD delivers income growth, while VTI builds overall portfolio value. Position 3, $100,000 in JEPI, 20%. GPI emphasizes high current income through covered call strategies. The yield typically ranges between 7 to 8%, producing roughly $7,500 to $8,000 annually. Yes, upside is capped and tax treatment can be less favorable, but this allocation provides strong cash flow immediately. SCHD increases income over time, VTI compounds growth, and JEPI enhances present income. Position 4, $50,000 in BND, 10%. BND provides stability. With a yield around 4 to 5%, it contributes approximately $2,250 annually. Bonds help reduce volatility and act as a buffer during market downturns, giving flexibility to rebalance into equities when prices drop. Final allocation, 40% SCHD, 30% VTI, 20% JEPI, 10% BND, total $500,000. Now let's look at the income, what this portfolio actually produces. Year 1, total annual dividends come to about $19,050. SCHD contributes $7,200, VTI $2,100, JEPI $7,500, and BND $2,250. That works out to roughly $1,587 per month, or about $1,350 after taxes. Real usable cash flow. Year 5. Income grows to roughly $28,500 per year. SCHD increases to around $11,500 due to dividend growth. VTI rises to $2,700. JEPI remains near $7,500, and BND about $2,800. That equals approximately $2,375 monthly, or around $2,020 after taxes, about a 50% increase without adding new capital. Year 10. Projected income reaches about $42,000 annually. SCHD alone generates roughly $22,400. VTI pays $3,500. JEPI still around $7,500, and BND about $3,100. That's about $3,500 per month, close to $3,000 after taxes, enough to cover basic expenses for many people. And remember, this assumes no additional contributions. If dividends are reinvested or more money is added, income accelerates even faster. Even without that, the portfolio more than doubles its income over 10 years. Now let's discuss taxes, because how you structure accounts makes a real difference. I divided the $500,000 across 2 account types to improve efficiency. $350,000 goes into a taxable brokerage account, holding SCHD, VTI, and BND. These are relatively tax-friendly funds. SCHD and VTI pay qualified dividends, which are taxed at long-term capital gains rates rather than ordinary income rates. Depending on your taxable income, that could mean 0%, 15%, or 20%. BND generates interest income that's taxed as ordinary income. However, since it represents only 10% of the portfolio, the tax impact remains limited. $150,000 goes into a Roth IRA. This is where JEPI is held. JEPI's income is often taxed similarly to regular earnings. Placing it inside a Roth IRA eliminates that issue. The income compounds tax-free, and qualified withdrawals in retirement are also tax-free. If you can't hold it in a Roth, it can still work in a taxable account, but the after-tax yield will be lower. The guiding principle is simple. Put tax-efficient funds in taxable accounts, and place tax-inefficient income inside tax-advantaged accounts. If you qualify for the 0% qualified dividend bracket, you may owe no federal tax at all on SCHD and VTI dividends. Even at 15%, that's still far below typical income tax rates. Smart asset placement alone can save thousands of dollars annually. If you want access to my full portfolio tracking spreadsheet, showing how to apply this approach for $50,000, $100,000, $250,000, or $1 million, along with my rebalancing calculator and dividend projection tool, I make those available to channel members. Members also receive quarterly portfolio updates with real performance results, early access to videos, and a private community discussing strategies like this daily. You can join using the button below or the link in the description. It costs less than 1 SCHD share per month, and the tools can help you build a serious dividend portfolio. I'd be happy to have you inside. Now let's cover rebalancing and the biggest mistakes to avoid. I rebalance once per year, every January. I review the allocation and bring it back toward the 40%, 30%, 20%, 10% targets within about a 5% tolerance. If SCHD grows to 45%, I trim it and add to underweight areas like BND or JEPI. If VTI drops during a correction, I buy more while prices are lower. This process naturally forces selling high and buying low. I don't rebalance during normal market movement, only after significant shifts. Now the common mistakes. First, chasing yield. Seeing JEPY's high yield and overweighting it destroys balance. Second, panic selling. Market declines are normal. selling locks in losses while dividends usually continue. Third, ignoring taxes. Holding tax-inefficient funds in taxable accounts can cost substantial money over time. Fourth, skipping rebalancing. Allowing one position to dominate increases risk. Fifth, spending all dividends too early. Reinvest part of the income early to accelerate growth, then spend more later once income goals are met. Follow the system. Discipline matters more than picking the perfect fund. Quick recap. $500,000 portfolio. 40% SCHD for dividend growth. 30% VTI for broad market growth. 20% JEPI for higher income. And 10% BND for stability. Year 1 income. About $19,050 or $1,587 monthly. Year 10 income. About $42,000 or $3,500 monthly. Tax-aware, rebalanced annually, and designed for long-term investing. This mix suits investors wanting income today and growth tomorrow. Younger investors may hold more VTI for growth, while retirees may increase SCHD and JEPI for income. The core principles stay the same. Balance income, growth and stability, manage taxes, and stay invested during downturns. What allocation would you choose? Leave a comment. I read everyone. Subscribe for more portfolio strategies, and I'll see you in the next video.